So far, I've been thinking about the banking system as if it's made up of these profit maximizing kinds of, I mean, we haven't really addressed that. You know, these people, these institutions, security dealers, banks, you know, they're not in this for their health, right? They're not doing it, you know, creating liquidity to be nice to us or something, to help us trade Apple stock. Isn't that nice? No, they're doing it to make money, okay? And they're motivated by profit, and we'll analyze how do you make profit by making markets? What is the source of that profit? Okay, we will do that in this course. What I want to emphasize, though, is that one entity, once the central bank becomes not a private banker's bank, but actually a sort of public entity, an agent of the state, an agent of the people, it doesn't necessarily focus entirely on profit maximization, or maybe not entirely on short-term profit maximization. This happened over time. The Bank of England was a private bank for a long time, but because it's sitting at the top of the hierarchy, and it's noting this fluctuation. Okay? And it's noting when things get really, really bad, what people really want are my own liabilities. You know, I have the best liabilities in the system, and so in a certain way, I can help them out if I want to, you know, and lender of last resort, Badgett, or J.P. Morgan in the United States, helping out his friends, okay? He was essentially a private central bank before we got the Fed, okay? So you could do this in a profit maximizing way, as J.P. Morgan maybe did, okay, in 1907. But once you realize that there is this sort of quasi-public function of the central bank up at the top, particularly managing these turning points, okay, there's this idea that some of these entities might be focusing on short-term profit maximization, maximization. And others might be focused on economic stability, making sure that the system doesn't collapse. Lender of last resort is the ultimate making sure the system doesn't collapse. Lender of last resort is saying when the principle of scarcity is causing the economy to melt down, the market makers are ceasing to make markets, and so therefore nobody can trade, and the whole system is in disarray, okay? I can, because I'm at the top of the system, introduce a little elasticity, okay? Because I can accept securities as collateral for expanding the money supply, something like that. So I can join the layers of the hierarchy that have all broken down because the market makers aren't making markets. That's what lender of last resort is, okay? That's an economic stability function. And over time, central banks have come to accept that and to say that's our job. That has evolved over time, that role of economic stabilization. It's evolved over time. What do central banks do? What do central banks do? The most primitive, you know, if you look back in history, one thing that obviously a central bank has to worry about is the exchange rate, so the mint par of internet. And you could just say that's the central bank's job, is to just defend the exchange rate and let the whole rest of the economy go to hell, okay? There are central banks that have done that, okay? But they've come to realize that that's not such a good idea, okay? That if the whole rest of the economy goes to hell, they're going to be sucked down with it, okay? So they might expand their remit to say, well, we have some responsibility also for helping the banking system maintain par. Okay, so that when they are experiencing a run, people want more currency and they don't want deposits. We're the central bank. We can help out because we can create currency. So we can help out. So central banks take responsibility for financial stability. Badgett's book, Lombard Street, okay, was, in fact, I have it here. I'll show it to you. Badgett's book, Lombard Street, a description of the money market here. This is got this a used book, Merry Christmas to Father from Ed, 1907. I love that, 1907, financial crisis of 1907. Some Ed is giving his father the key to understanding what's happening in the financial crisis. Lombard Street, a description of the money market, pounds, shilling, pence. Here is what that's about. So it's about the London money market. And what Bagehot tried to convince the world with this book, okay, is that central banks, that the Bank of England, okay, a private central bank, had in fact, during previous crises, been acting as a lender of last resort. It has sort of evolved in that way without intending to. Okay? And that it should bring this up to consciousness and embrace it and say, what we're going to do in a financial crisis is lend freely at a high price against good collateral. That's what we're going to do. And you should just embrace that. It was very controversial when he first published this, and then it became orthodoxy. Okay? That central banks all say, yes, this is all orthodoxy. We must do this. What I want to just draw your attention to now is that once you have embraced that and said, that's what we're going to do, you know, if we get to the ultimate scarcity of ultimate money, and this is causing trouble that the economy is breaking down, we are going to step in. Okay? That then makes the bank, if you've taken that responsibility on yourself, okay, that then makes you want to say, you know, it would be kind of good if we could prevent ever getting to that point in the first place, actually. You know, if somehow we could intervene in the economy before it got that bad, we know that it's going to be all on our balance sheet, you know, if we get there. So let's try to have monetary policy. This is actually the origin of monetary policy. The notion that by manipulating the interest rate or something like that, you can somehow prevent this fluctuation, okay, from getting too extreme. You can lean against the wind. When it gets too boomy, you raise interest rates. You try to implement scarcity when the economy is all about elasticity. And then on the other side, when it's all collapsed, you know, when the economy is all about discipline, you try to implement some elasticity. Okay, so this counter-cyclical kind of effect, counter-cyclical policy, comes from the inevitability of thinking of hoping that you can do something about that. It comes from taking responsibility for the crises, that you're going to intervene in a crisis, so let's try to prevent a crisis. And not just countercyclical policy, but also prudential policy. Let's try to regulate banks and make sure they don't get overextended. Let's make sure they don't buy crap assets. Let's do, you know, all this stuff that you see as regulation is ultimately coming from the fact that the central bank is taking responsibility for the ultimate crisis. So let's try to prevent this crisis from happening in the first place. How does the central bank do that? This is my last image for you. Interest rate. The central bank intervenes, most central banks intervene by manipulating a very short-term interest rate. The Fed funds rate in the United States, some policy rate, overnight rate, very short-term rate. There's a term structure of interest rates that typically looks something like this, okay? So down here at the short end, you're talking about overnight money, 1 day, okay? And out here at the long end, you're talking about 30-year Treasury bonds. Okay? This is called the term structure of interest rates. Here at the short end, we have the policy rate. Okay? Here at the long end, okay, we have the market rate. Okay? In general, private markets, security markets, these are securities, 30-year bonds, right? So private market securities are determining these rates here, okay? And central banks are determining these rates here. So who wins? Okay? There's this theory, which you've probably seen in other economics classes, the expectations theory of the term structure, okay? Which is to say, well, the 30-year bond should just be, the yield on the 30-year bond really should just be the expected overnight rate for the next 30 years, just rolled over. It should be exactly equal to that. And this theory is wrong, okay? Empirically wrong. It's rejected basically all the time. But economists don't have a very good understanding of why, actually. We're going to talk about that in this class. It's the sort of thing, it seems like arbitrage. It should be, why would it be rejected? It seems like it really should be true. But it is not true, empirically. And that tells you that there's something else going on here, and I'm going to argue that it has to do with liquidity. Okay? But we need to get clear about what liquidity means before I can make these kinds of arguments. What I'm emphasizing right now, at the beginning, big picture, okay, is that we have a policy rate, we have a market rate. Policy is trying to move the market around, okay, by moving this interest rate around, but the market is also creating constraints on what policy can do. You can't make the market do just anything you want. But on the other hand, if you let the market dictate what you do, you're just accepting the hierarchy as it is. Monetary policy is all about creating an artificial hierarchy of money and credit. Okay? Partly you can see that in this. Remember that hierarchy I told you? It was like gold at the top, then currency, deposits, securities. Well, here we have basically overnight money at the Fed, so this is currency, okay? And here's securities, okay? And the Fed its attempt to influence this pyramid, okay? It plays out in these prices. It's an attempt to influence the prices of these securities out here, and the steepness of that. When a central bank wants to impose more discipline, okay, what you'll see is this, okay? A negatively sloped term structure where short-term money is ridiculously expensive, more expensive than long-term money. This is ultimate scarcity. And when it wants to make the pyramid more elastic, short-term interest rates are lowered way below long-term interest rates. So the attempts, what we call monetary policy, is really the attempt of the central bank to say, well, the system has a certain balance between elasticity and discipline right now, but I don't like it. Okay? I think it should be more elastic. I think it should be less elastic. So monetary policy is about that, is about choosing where to be on that. And there's politics about that and all of that, okay? And we can talk some about that. But the actual mechanics of it are pretty interesting by themselves. And that's what mostly this course is about, is to really try to understand, this seems a very thin reed to hang your whole monetary policy on. An overnight interest rate, what is the connection? How does changing that rate do anything to the pyramid? Where exactly is the transmission mechanism, the transmission mechanism of monetary policy? How does it really work? The market is enormous. Remember, this pyramid, right? The credit market is enormous, really, really enormous. How is it that puny little Fed, okay, can have any weight on it at all, any influence on it at all? I think really it's a serious question. Once we get inside the system and we understand, we'll be able to ask those questions more precisely. What I want to leave you with here is the evolution over time of the role of the central bank, from defending the exchange rate, defending par, to more broad concerns about economic stability. Ultimately, there was a period of time when the central bank thought, maybe we can eliminate the business cycle. Remember I said this fluctuation thing happens at all time scales. Okay? Maybe the central bank can create an artificial hierarchy and just eliminate the business cycle. That whenever it looks like it's going to slacken, we'll create more elasticity. Maybe. That was an ambition. One of the central questions we're going to be concerned with in this course this semester is, what is the proper role of a central bank today in this financial crisis? We started today by talking about Mario Draghi. and his attempt to put a floor under the crisis that is happening in Europe by putting a floor under the price of short-term peripheral bills, okay? By buying them himself, okay? He was being a security dealer. He's buying Portuguese debt, he's buying Spanish debt, he's buying Italian debt, okay? So this is a new role. He's not supposed to do this. It wasn't anticipated that he was going to do this. This is a new role. Similarly, when the Fed, in our crisis, 2007, it bought $1 trillion worth of mortgage-backed securities, there had never been any mortgage-backed securities on the balance sheet of the Fed. Not since 1913. Never. There had never been mortgage-backed securities on the balance sheet of the Fed. And suddenly, in 3 months, there's $1 trillion worth. Okay? So I'm just alerting you that we're living in a brave new world where we're reinventing, trying to figure out what is the appropriate role of the central bank for our modern times, for our modern global financial system, okay? For the shadow banking system, for all of that, you know, and we don't know the answer. We don't know the answer. We're making it up. The central banks are all kind of just reacting, okay? But we're living in a Bagehot moment. Bagehot was writing in 1873 when he looked back and he said, all this stuff you were doing, it's lender of last resort, and you done good, okay? Bring it up to consciousness and embrace it. Lend freely at a high interest rate against good collateral during a crisis, and you won't have any crises anymore. You'll be able to put a floor on them all the time. We don't have a simple rule like that anymore for the world that we're living in, and we're looking for one. So that's part of what this course is about. Is that sort of search and seeing how this kind of rule is emerging in practice. What are central banks actually doing? They're responding to where the stresses are. Step back. What did they actually do, and why did it work? Or what did they do, and why didn't it work? You know, there's lessons to be learned from this crisis, and the clock is ticking. We don't have a lot of time. There's a lot of the stakes are pretty high. So that's what this course is all about. And I'll leave it there. Leave it there. Any questions or? Yeah. Operation Twist he's asking about. What he means is this, that the Fed has been entering in to buy the long-term bond market. Okay? It has been buying long-term bonds. It has not been sticking with just fixing the overnight interest rate. And so, yes, that is an attempt to influence the shape of this pyramid. Whether it's been very effective or not and even what the mechanism is. There's a lot of debates about if it's been effective, why has it been effective? Nobody really knows. I have a view on that, which we'll get to later on.